we got some really interesting price action here from the S&P 500 from the bond market, and the dollar's still sticking where it's at. But let's take a look at the S&P and how it's going to be reacting to this, this slowing housing market from rising rates. All right, we're going to get to the housing data because basically what we're seeing is housing market risks starting to increase. The housing market was, or the real estate market in other words, was starting to recover, but that is not the case. That is not the case right now. Now it's pretty flat, and we are going to take a look at that. It is because of these rising rates. So the interesting thing is, okay, 2-year rates. If you look at it here, 2-year rates have been slow, but now they're starting to press higher again. All right, let's take the RSI off. So today this candle is green, which means today 2-year rates are rising. Let's go to 5-year. 5-year rates going up. But, ironically, the 10-year rates, right, the 10-year bonds slow down. 10-year bonds or 10-year rates are starting to slow down. 30-year starting to slow down. They're still pretty elevated, but they are beginning to slow down. And so there is a shift taking place on today. Maybe it continues the other way, but you are getting some divergence in the bond market. And I wanted to point this out before we get to housing, and we're going to come back to this, which is that bonds are starting to catch a bid here. There's been a lot of bond outflows for U.S. bonds, U.S. treasuries, and I think it's going to reverse pretty soon here. We're starting to see bullish divergence, and this will usually play itself out. You need something really negative for this not to play itself out. And I think it will. I think eventually will play itself out. As long as this does go bullish, you're going to get rates come down, at least on the long end, because TLT is mostly long end rates. So we should see rates coming back down maybe in a couple weeks. Now, I'm thinking the way rates actually do come down is this Friday. This Friday we have Jackson Hole, which is, Jerome Powell's symposium. Or to make it clear, this Friday is the big Fed speech. Right, this is the big Federal Reserve speech from Jerome Powell. This is his Hollywood moment, and he's probably going to be a little hawkish, but I think in the end, he calms down the markets. I think he's going to calm down the markets because if he doesn't, you're going to get a lot of collateral damage. And what I mean by that is, let's just take a look over here at the housing market, kind of see what we got some data today from the housing market. All right, and what we're seeing, first off, let's look at this. 30-year rates, right, at 7.2%. 30-year mortgage rates, right? That's what kind of we're looking at. This is the housing/real estate market. And these rates are at 7.2%. They're about to break out, or they are kind of breaking out from the highs in October. But we're not getting elevated inflation. This is more so growth is accelerating. And rates go higher for two reasons. Either growth is starting to reaccelerate, or inflation is reaccelerating. But we're not getting an inflation reaccelerating. We're getting growth reaccelerate. So this is a good reason. This is a good scenario for rates to go higher. You don't want rates higher. They're already too elevated, but it's a positive outlook. It's less worse. It's less worse than actually going up because of home. Oh, there you go. What up, Dima Yush? What up? Housing prices up, sales down. Right. Maybe so. We're going to get into that. I think, this is basically 30-year rates, right? And real estate loans are down. So real estate loans peaked, I think in April, real estate loans, they're starting to fall now. And so because they are falling, not because they're falling, but because rates have been so high, they just couldn't, the loan demand started to fall. So there's a lot of conflicting data, but basically these rates continuing to climb are putting pressure on real estate loans, right? The demand for loans, obviously. Sorry, can't listen to this Hopium today. 100%, no problem. So again, interest expense, right? Interest expense is climbing while mortgage rate sales volume is falling. So the housing market bounced and now it's starting to roll over, right? Now it is rolling over. It's not going to the lows yet, but if these rates continue to climb, if the interest rate expense to borrow money continues to climb at the 30-year, right, for these mortgages, then sales volume for sure, I don't know, we don't know, but sales volume is definitely falling. So this is a big risk to the market. The Fed has to do something on Friday. They're either going to let this continue, or they're going to bring some optimism to the rates market, or the bond market, which is, hey, don't get too concerned. We can back these banks' collateral. We can back maybe our policy will pause here. I think a pause is enough to get, rates to calm down from where they're at. Just the Fed announcing a pause or signaling a pause. Okay, that might be the case. So building permits, right? You still even build your permit. So when we look at these now, just so you know, okay, let's take a look at what are existing home sales really quick because we didn't even go over that. So, let's keep it there. Sales volume, right? Existing home sales, right, is just the sales volume. These are existing home sales. I just want to go over that really quick. And when those sales volume falls, it just tells you, there's a pause going on in the housing real estate market. Growth is starting to stagnate primarily because 30-year rates are up, right? Long-term rates are up, not short-term rates. Short-term rates have stalled, but long-term rates are up. All right, so building permits. So home builder sentiment actually did peak out, right, in the last couple months, and now you see building permits are pretty flat. So what are building permits? Building permits are basically the permits that home builders have to obtain before they start construction. So that's going to be a slowing in the economy. That's going to drag down the economy. Maybe the economy does start to slow down in this third to second half, at least in the housing market. Consumers are spending, but the housing market is at a stalling right now, right? And it's going to take the 30-year rates. It's going to take rates in general to actually come off the highs, for that to stabilize. If they keep going up, it's more than likely we're gonna see a housing or real estate market collapse. Not complete collapse, like, oh, we're going into a big crash, because I think the Fed will step in and say something, but you do teeter towards a collapse, okay? Now, if rates come down, the housing market stabilizes. It's simple. It's pretty much as simple as that. Okay, so let's take this off, get back to the market. So what are we looking at here, right? This is TLT, and TLT is basically a proxy for the bond market. Actually, let's get into our charts here, okay? And the bond market is selling off pretty hard. Now, the reason why this is an issue, not just for the housing market, right, causing housing market volatility or housing rates climb, it's going to bring down housing. That's kind of lagging. That'll show up a little later, right? And if you do have your comment, let's see, that'll be good. So anyways, TLT is coming down. And what this is basically a reflection of the collateral for the banks, right? Because right now we just got some bank downgrades. We got, who was it? Moody's. Let me see. Who was it? It was Fitch downgraded, we know, like 2 weeks ago. Moody's downgraded. These are rating agencies, debt rating agencies for the S&P, or for the U.S. These are rating agencies here, and they downgraded banks. Moody's did, Fitch did, and now the S&P also downgraded. So what is this downgrading about? It's basically the collateral is falling, right? And it's like a Jenga. It's like a block of Jenga, right? If the Jenga blocks start to fall beneath you, your base, well, the whole collateral is at risk, right? The whole tower is at risk. Now, we're getting close to that. We're getting close to too many Jenga blocks coming out, which is literally this bond market falling, right? This bond market coming down right here. And the closer we get, and there's a lot of inflows into bonds, right? But the closer we get to this collapsing, you're going to need somebody to step in. You're going to need the Fed to step in, or you need the Fed to step in to prevent some black swans from happening, because you could start to get some black swans if this is the case. So this is a risk, definitely. But I think Friday's speech is going to either stabilize the markets by announcing a pause, like, hey, no more, or it's going to accelerate this move on the collateral to the downside, causing more risks to the upside. All right. Now, going to the dollar, right? Here's the other part of that risk. The dollar climbed again today. So the dollar is still at resistance, but it's not falling as fast as we thought it was. Okay. It's not now. It's still nearing the top. Like, I think this move is still taking place. I do think the dollar is either going to break out on Friday, or it's going to pause on Friday or roll over on Friday. Friday's the big day because it is the Fed speak. It is Powell coming in and giving his outlook on where he thinks rates should go. He can calm the bond market by basically signaling, hey, we're going to pause this month. If he doesn't signal the pause, if he signals that they're going to keep hiking rates, that they have to, then it is likely more risks start to enter the market. And the S&P probably won't hold that upside. We should see the VIX start to spike if that is the case. We're not seeing it spike now. We should see this put to call ratio start to turn back up, more puts into the market. Okay. But we are entering disinflation too at the same time. So no longer is inflation the risk here. The risks of inflation are actually falling, which is why I think the Fed can pause. The risks rising are going to be growth. And this is the case as long as we get oil. Look at this head and shoulders, right, on oil. Oil is a clear head and shoulders. There's your shoulder, there's your head, there's your shoulder. Now, this is just a probability. Maybe there's a 50% chance we drop below 78. And if that is the case, the Fed can ease, right? The Fed can actually ease here. They can ease expectations. And it's not just oil that they're looking at. There's a lot of factors that they're looking at, but obviously mortgage demand is falling a bit. Obviously, existing home sales are coming down. Obviously, the real estate market is in trouble. You need more construction. You need more builder supplies. Now, I know a lot of people are pointing at home prices are accelerating. Yes, they're going up, but that's not inflation. Okay, that is not inflation. That is disinflation. That is disinflation. Home prices always accelerate. And I know people get upset about this, but home prices always accelerate over time. That's why it's literally a store of value. That's why people invest in housing prices. We are actually seeing disinflation, which is the slowing down of the price increase. It's just slowing down. That's disinflation. That's good for the market. Is it good for the housing market? Probably not. Is it good for home buyers? No, because the interest rates are too high. But as a investment versus the stock market, disinflation is good, right? Disinflation is good because it tells you that more capital can allocate itself towards more riskier types of assets if we do get rates coming down, right? So I know, okay, yeah, housing prices are going up, maybe in some regions, but we got to look at this as an overall. Like if you look at Zillow and you look at Redfin, housing prices are not accelerating. Okay, as far as inflation, as far as the rate of change, it's what is inflation? Good, very good question. It's a really good question. What is inflation? Inflation is basically, everybody wants inflation as much as they say, inflation is terrible. Everybody wants inflation. If you own an asset, you want it to inflate, right? If you own stocks, you want it to inflate. If you own Amazon, you want it to inflate. If you're working at a job, you want it to inflate. So inflation in itself is not terrible in this system. It's only bad if you're misallocating your resources. If you're owning the inflation, you're in good standing, right? But if you're paying for the inflation, that's where you're in trouble. So it comes down to personal choice a lot of the time. Not everybody is lucky. Not everybody's educated on it. Not everybody understands how it works. But you do want your wages up, right? So that's good inflation. You want your assets, if you own them, to go up. That's good inflation. But you just don't want your items, your goods and services inflation to accelerate faster. And if you think that you want deflation, that is not the answer. Deflation means prices go down, they turn negative, right? We're not in deflation yet. In some areas we are, but we're not in deflation. We're in disinflation, which just means the rate of change of inflation is falling. That's it. The rate of change is falling. And if you get deflation, earnings go down in the S&P, your assets go lower. So deflation might be good for your groceries, for housing prices, but guess what? Jobs start falling apart. You get less jobs, right? The economy falls apart. So you want disinflation. You do not want deflation. All right, that's not good. And debt burdens rise as disinflation rises, as deflation comes in. So you want disinflation. So it's just people get so negative about inflation. It's so elevated. I heard that it's now a right-wing, it's a leftist talking point and or whatever, to talk about inflation, but I think people just don't understand inflation. You want inflation in a good balanced area, right? Anyways, back to the market. Oil prices finding resistance at that 83.50 level, starting to roll over. This is so positive for the market, right? Yes, 30-year yields are up. And how high do they go? I think what they're doing is they're just, long rates are just front running the Fed meeting on Friday. They're factoring in, the bond market is factoring, it is selling off right now. It is factoring in Fed Powell staying hawkish, right? His expectations are to hike rates even further. That's what it's doing, in my opinion. That's just what I think. So go ahead and put me to the test. If he comes in hawkish, then bond yields probably keep going up. But if he comes in dovish, they sell off. Or yields come back down, right? The dollar comes back down, okay? And the positive is, again, like I said, inflation on the energy sector, or the energy inflation, the cost of energy, oil prices are pretty much sideways. So that puts us at a pretty break-even inflation print in September. Very optimistic there, right? We already know the negative. The negative is that the housing market, I'm sorry, not the housing, the negative is that these rates continue to climb and put pressure on earnings for riskier assets, right? And right now we're getting the 5-year. This is not actually terrible news right here. You're getting the 5-year or the lower part of the curve short-term rates start to retest the highs. This is not good. This is not good, which is why I think Friday is going to be the big day when Powell comes out and actually speaks on what's going on here. All right. So that's sort of what we're getting as collateral is at risk, and the whole system starts to fall apart, and you're getting bank downgrades coming into Jackson Hole on Friday, coming into Fed Chair Powell. Now, can rates actually reverse? I think they can, and it's going to come, like I said, it's going to come down to what Fed Chair Powell says on Friday, right, on the speeches. My instinct is he's going to try to keep it, pretty break even, pretty hawkish, pretty dovish in some parts, but he has to acknowledge that inflation is making progress. Okay, it's not accelerating to the downside, but you don't want that either. You want it to slowly come down in some areas. You want energy to definitely come down. So we're still in solid shape here. And then when we look at the technicals for the market, okay, let's just look at the risk factors here. The VIX, right? The VIX is not materially, well, this is volatility VIX. The VIX is not really, it's trending higher now. Yes, the trend is sort of going up, but the trend is not, it hasn't changed yet. So volatility or investor psychology, because at the end of the day, prices are what matter. No matter what you think your thesis are, if prices keep going up, you're probably wrong. As a matter of fact, you are wrong if you're looking at the stock market, okay? Because the stock market is looking much further ahead, and it is a beast. It is a market. It is not a single factor. So VIX not really going nowhere. Insurance against the S&P not really going anywhere. How about the Nasdaq? No, it's still pretty low. How about the bond market? Oh, whoa. Okay, here's a warning. Here's a warning we're getting, which is bond market volatility is starting to pick up. This is actually something to pay attention to, because if this is the case, then if it does break out, then you're definitely going to get some risks coming into the market, and the S&P is probably going to come back and retest those levels, and that's basically going up. And we'll see if the bond market volatility continues. It's going to come down to Friday. Again, like I said, it's going to come down to Friday and digest over the weekend. So S&P 2 days in a row green, comes back and checks and holds that support level. I don't know if it continues to hold because, like I said, Jackson Hole is the big meeting on Friday. So here's the positive, though. We're getting closer to the end of the Treasury issuance. So a lot of this volatility coming into the market, a lot of this yields going up, is a part of the Treasury, the general account, the U.S. Treasury increasing supply of bonds. So we're at the end. We're near the end of that. Those bonds are getting eaten up, not too much, because they're not getting there's not enough demand yet, because if you get more demand, then these rates come down. So we're not seeing too much demand, but we're getting to the end of that issuance. So if that issuance from the U.S. Treasury starts to slow, or starts to come down, or finishes by the end of August and September, then the demand probably comes in, right? It starts to overcome the supply, and then you get the yields start to come back down. Another signal for that is TLT showing this. I told you we'd come back to TLT, and TLT is showing a bullish divergence, meaning buying pressure is coming in. And there were a couple charts showing that are some reports showing that the ETF flows for bonds are at a record high this year. They're exploding. So there's a lot of people interested in bonds. I expect this bond price, the price of bonds, TLT as the proxy, as the trade, to start surging back up. Maybe not surge, but to bounce here, right? This might be the bottom. So if the buyers step in here, if this RSI is correct, then that's going to push yields back down, and then we get a recovery. All right, so there are inflows coming into the bond market. Got a question here. You think it will already be too late when they reverse? Do I think it'll already be too late by the time they reverse on rates? Are you talking about cutting rates or pause? I think the pause is on the table. Will it be too late for bonds to sell off? No, I don't think so. The U.S. Treasury, we can't predict this. We got to keep watching the bond market. I will say this: if long-term rates continue to steepen the yield curve, so if we get No, here we go. 30-year rates. If we get 30-year rates continually to break out, right? Then and the Fed still hasn't, like, if the Fed pause doesn't hold this, doesn't keep this steady, then yes, it's going to be too late because you're going to get a market sell off to some degree. It might be the last one before they actually step in, before they reverse course. But I think they're close to it. I think they're very close to it. And one of those reasons is that, inflation, CPI is still a big factor for the Fed's decisions. And oil is the biggest factor for CPI headline, not core, but CPI headline. Okay. And also, I think consumers spending is pretty much going to slow from here. It's not going to keep speeding up. It is holding the economy up, but it shouldn't keep accelerating at this point. And that's also going to slow down core. And core is already slowing down. Shelter's coming in, starting to roll over. All right, how you doing, Spike Dodgeball? When do they cut? I think that, really depends on whichever way you like to gamble. Oh, I missed that one. Nvidia short or long before earnings. Nvidia, to be honest with you, when I look at Nvidia, okay, and I got Nvidia up here on the on YouTube, Nvidia is doing something. Honestly, I think there's a bigger probability it sells off because it's running up so strong into earnings, and typically, and this is before the Fed speaks. Okay, I hope I'm wrong. I really do hope I'm wrong because Nvidia is, everybody, you hear it. Nvidia is going to change this market. It's the new Apple. I really doubt that. Let's go to Apple, AAPL. Is Nvidia the new Apple? No, it's not. It's not the new Apple. It's just a growth, hyper growth scaler. Is there still demand for AI chips? Is the story over? It's not over. It's not over, right? All the geopolitical uncertainty is about technology. It's about chips. So this is not going to change. Now, does that mean earnings are going to be great for Nvidia? I don't know. They could have pretty good earnings and still sell off. But usually on a technical basis, this setup where you get a run up into earnings is usually negative. I'd rather see a sell off into earnings to have confidence that price continues higher. So Nvidia gets back to the highs. I could be wrong. I really hope I'm wrong. But usually when you run up into earnings, sort of like we saw with Tesla, you do get a sell off into that move. So when will the Fed cut? The Fed will likely cut when core inflation drops into the threes, okay, and headline drops into 2.5. That's what I think. I think you need to headline at 2.5%, and you need core into the threes. We're definitely not there yet, but shelter at some point can bring that factor into place. Now, I know people keep saying housing prices are going up. Bro, housing prices will always go up. They don't decline unless you get a great recession. But guess what? Inflation didn't go up as housing prices went up. So you guys keep confusing price appreciation with inflation, okay? Inflation is always going to happen, and prices will always go higher, but that's not the risk. The risk is that prices accelerate too fast. We just need housing prices to go up by 2.5%. Okay, we're not there yet, but guess what? They're not going. The prices of housing prices are not accelerating; they're decelerating. The reason why housing is a risk here is because the rate of interest is going up. So that makes the housing price, the cost to own a house a lot more expensive. Okay. Now that can change dramatically if the Fed cuts rates. That's why it comes down to this Friday, Jackson Hole. What is the Fed going to say? All right. What is the Fed going to say? So that's going to be important. And we're going to watch the VIX to see if there's any changes on the VIX. We're going to see if there's any changes in bond volatility and triple B spreads. Triple B spreads, which is equity risks, are still climbing at the moment. So right now we're pretty much in a risk-off macro environment, right? But the dollar is close to rolling over. Bond yields might be peaking here, and and the VIX. I think the VIX is also peaking. So it's just going to come down to that. Now, looking at the technicals, all right, looking at the actual technicals of the market, because at the end of the day, you only have so much news. What are people actually doing? Let's take a look at what people are actually doing here. You see the RSI bounced from the lows. The RSI might have one more flush lower. So if, let's say Jackson Hole is very bad, the Fed is, and this is a NASDAQ, by the way. Let's say Jackson Hole is terrible. Let's take the volume off here. And he comes off very hawkish. We could see, we're coming into resistance. We could see NASDAQ come right back down, even capitulate down to, 1400, somewhere around 14.1 before we start to recover. And, I still think we do recover because the inflation, the CPI backdrop is looking good. Um, but if he does signal he's going to keep hiking rates, which I really doubt that. I think he'll signal that we're going to hold higher for longer. That's probably the more probabilistic outcome, is that he just says we're going to hold higher for longer. Not really, we're going to keep hiking rates. Things are coming down, okay? The inflation backdrop, disinflation is happening, okay? I keep saying inflation, people get confused. Disinflation is on the table, right? The rate of increases in prices are falling. That's disinflation. All right. Nvidia short or long. Oh, yeah, I already read that. Yeah, we'll see how that works out. Fed doesn't want to cut because OPEC will cut oil production, which means inflation, which is why we're looking at the price of oil. And guess what? If OPEC keeps cutting production, they've already cut, right, twice, then there's a risk for OPEC cutting production. The risk is that if they keep cutting production, they're going to lose market share, right? And they don't want to do that. So can they do it? Sure. But you got to keep in mind psychologically, OPEC doesn't want to just keep cutting just because they can, right? Why not just keep cutting and make prices go higher? Why aren't they cutting every month? Because it's a psychological game, because you lose market share if you do that. Okay, because OPEC themselves are not just, in unison. Russia, Iran, some of these countries are actually increasing production. They're increasing supply while others are cutting supply. So OPEC is not in unison. And yes, they can keep cutting, but guess what? Demand is still falling. We see China's not recovering. So I think, we got to keep our eye on actual crude oil futures. And right now they're showing bearish divergence. Right now they're showing that they're coming back down. So CPI should be lower in the next month. So far, right? That's my guess. We have 8 more days. We have 1 more week. And if this week finishes off weak for oil prices, expect that September CPI report to be very optimistic. Possibly, we drop to the 2s for headline CPI. And that's going to be very good for the market. So maybe the market does get crushed over the next couple of weeks until that CPI report comes out. All right? Keep your eyes on that. We don't know. Fed does... And you also said the Fed doesn't want to cut because the OPEC will cut. I don't know if that really ties into each other, the Fed cutting. The Fed doesn't want to cut because they don't like cutting rates doesn't make oil prices go higher. Cutting rates would make stock prices and asset prices go higher. You need more demand for oil prices to go higher, if that were the case. So also if the economy starts to increase productivity, which people get really confused about, if productivity increases for the economy, and there's more output, right? You don't get oil prices going higher. You get more output. You get, no, I'm not saying that because you cut rates, you get more output. But if the economy grows production, the production side, which we are seeing, and you get more output, actually prices come down because you have more supply online. So these dynamics are tricky, right? It's not just one or the other. It's not binary. It comes down to exactly how they're playing themselves out. All right. But anyways, if they cut rates, asset prices go higher, not initially the price of oil. You need cut in production. Fed versus OPEC is the real battle. Okay. You could say that Fed versus OPEC. That's one way to look at it. I don't look at it that way. But you can look at it that way. Fed versus OPEC, right? I guess you could look at it that way. Energy versus interest rates, global interest rates. I think it's more of the Fed versus China right now, because what we're doing is, as we keep rates high, we're crushing the Chinese economy, right? We're keeping them. And remember, Biden is putting on, and don't get all political here. This is not political at all. Biden is, or the Biden administration, the White House, right? Whoever's pulling the strings is putting restrictions on chips that go to China, because we are competing with them, just like World War II. We're competing with them for technology. And so I think there's a possibility that the Fed is keeping rates higher for longer to actually crush China, while the White House pumps fiscal liquidity, infrastructure bill, CHIPS Act, Inflation Reduction Act. More jobs are picking up. Our consumers are spending, so our economy stays strong while they have to debase their currency and weaken, their economic outlook. So I think that's more of the case than OPEC versus the Fed. I don't know if that's really a thing. I mean, we're the number one energy producer right now in the U.S., and we produce the most oil. OPEC does affect the market, but again, if they cut too much, then we just take more market share. You think the U.S. is cutting supply? You think the U.S. is cutting oil production? No, we're increasing oil production. So the more that they cut, the more that you got to understand. The more it's a battle, right? It's almost like you're playing chicken. The more that OPEC cuts production, the more market share they lend to the U.S., they lend to South Africa, they lend to other, oil producers, Venezuela. So it's not that cut and dry, right? It is plain chicken. So if they keep, I don't think they keep cutting. Can they do it? Sure. If demand ticks up, they cut a little bit. But if demand keeps dropping and they keep cutting, they're going to hand over the keys to that, what do you call it, cartel. They're going to slowly hand their keys over. So that is the case that I'm seeing right now. Maybe I'm wrong. Anyways, bullish divergence on bonds. If bonds start to pick up, right? If we get TLT, and there's a lot of inflows coming into TLT. If we get that pick up, then yields come back down, the market can ease, and the S&P 500 can find support here. And guess what? We went up 2 days. I can see obviously, I really think that we sell off. We keep maybe ticking up. We got Wednesday, Thursday. I think NVIDIA might make it. I don't think NVIDIA is the big risk here. I know people think it's NVIDIA. I don't think NVIDIA is the big risk here. I think the big risk is that Powell is too hawkish on Friday. So maybe we stay sideways or higher Wednesday, Thursday, and then we start to sell off Thursday evening, right, at the end of the market close. Oh, maybe I'm wrong. I'm just taking a guesstimate here. But I think Friday is the big day because really all this risk is about the collateral. It's about the bond market. The bond market is trying to front run rate hikes. The bond market is trying to front run the Fed hiking rates. If the Fed hikes rates, they're right. But if the Fed cuts rates or signals a pause, the bond market has to reverse, right? They have to reverse because people who are investing in bonds, they don't want to. They're basically their bond value, the future expectation for bonds goes down because the rate of interest goes down, and there's going to be more bond buyers coming into the market because the economy is slowing, and stocks look more attractive. Period. Right. Period. So we'll see how it plays out. What else do you got here? Fed cuts makes dollar weaker, makes oil expensive. Fed cuts. If the Fed the Fed ain't gonna cut this meeting, but when the Fed cuts, it makes the dollar weaker. 100%. It makes the dollar weaker. But what really makes the dollar weaker isn't the Fed cutting. What really makes the dollar weaker is the Fed, turning the QE back on, right? Actually starting to buy up U.S. Treasuries. That'll make the dollar weaker. And initially, it will make the dollar weaker if they do cut rates. So that is true. Now, you also said that it makes oil more expensive if the Fed cuts rates. Well, makes oil more expensive. Not exactly. If you cut rates, then you're making the cost to produce oil cheaper. So not exactly. I disagree with you on the oil front. What makes oil more expensive is you cut demand. You cut production or you increase demand dramatically. So what would make oil go higher is direct stimulus checks to consumers. That would make oil go higher. Direct stimulus checks would make oil go higher, but not cutting rates right off the bat anyways. Cutting rates might actually be better, a better outlook. So this morning we had some Fed speak. We had... who do we have speak this morning? We had, I know I put it on here. Here we go, Fed Barkin. So one of the Fed members spoke. He said the recent move in bond yields are not a sign of inappropriate market tightening. They're likely a response to strong economic data. Okay, and that's what I'm saying here. I agree, which is with the Fed there is, the economy is strengthening. So rates are going higher. That's not negative, okay? Plus people are earning cash on their earning yield, they're having earnings on their cash. Okay, so that strengthens the economy further. That strengthens capital markets even further, which is really, I think the biggest risk here is just bank collateral falling, but not really the consumer. It doesn't hurt the consumer. Most people are locked in on their housing rates. Most people are already locked in. Okay, we saw the other day that equity debt is already locked in till 2030. So these rates aren't necessarily hurting the stock market or consumers as much as they are hurting banks that are holding those bonds as they sell off. Hopefully that makes sense. Now, what else did he say? Consumer spending and economic strength make it possible for the U.S. economy, that the U.S. economy could reaccelerate before inflation cools. Now, can we accelerate and inflation cool? Yes. Is it likely? Not really. If we accelerate, if you accelerate with more productivity, inflation can keep cooling. I'm in the camp that inflation is actually much lower than it's showing because shelter is a super lagging data point. It is a super lagging data point. Okay, so real-time inflation is much lower. Real-time inflation is much lower, and it's just a matter of time. Really, the market just needs to see the Fed, reverse course with their language, So the bond market can cool off, and the stock market can find legs again. We know earnings are being revised up. We know the Fed GDP now forecasts are up, and that's kind of what's keeping the bond market pushing rates higher in the short term. Let's see what else do we got here. What up from Hawaii? See what else are we missing. We're going to do Tesla technicals also. How will Maui rebuild? Probably more government stimulus, right? And actually, ironically, the housing market in Hawaii falling apart is actually going to lower inflation. So, is it orchestrated? I know that there's a lot of conspiracies out there and a lot of evidence, whatever. Either way, that'll actually lower the rate of inflation, because a lot of debt, a lot of those housing prices basically went to zero. So maybe insurance spikes a little bit, but for the most part, the shelter costs for Hawaii went lower, and that's kind of the conspiracy, right? You want lower shelter costs. All right, so really quick, we're gonna shift over to thank you. We're gonna shift over to Tesla technicals, because hey, if the S&P finds support here, I think Tesla is looking really good here. So first, RSI got oversold, right? Every time we get that RSI oversold, we get a bounce for Tesla, or at least we start to consolidate. This was from the low. So obviously here, right? This was back December when we first made the big run from the lows. You had the RSI go super negative. You could get one of these where the RSI goes negative and then it bounces and keeps going negative, but that would mean the overall market would still dip, and you have to have some negative Tesla catalyst. So if you get negative catalyst and the overall market rolls over, then yes, this uptrend for Tesla probably ends and you're going to go bearish. But we are pulling into that previous support. So there's a lot of support here around 215 to 230. A lot of support on Tesla. The previous resistance level, we are bouncing off that previous resistance level. We broke out of, see if I can actually make this a little bigger. Also keep in mind, we broke out of the bear market trend, and now we're retesting that trend. Here we go. So this was the bear market trend, right? The big flag pattern. When you get these big flag patterns, you're basically looking at a breakout from the flag pattern. So we saw that breakout here, right? Here's the flag. Like you get this, downwards descending channel. We broke out of that flag pattern. We came back and retested it. So we're retesting the flag pattern, showing some support today. That also happens to be the support of the previous resistance level, which is also a strong support. And it also has to be, this is triple support in my view, this also happens to be the support of the trend, right? The trend that we're seeing. So you get trend support too. So you got 3 layers of support here, and Tesla is now testing the downtrend and trying to find that downtrend support. So we are looking for that. Also, if you do anchored VWAP if we look at anchored VWAP, you can see, so if I do anchored VWAP, we're still holding the anchored VWAP, which is basically volume weighted average from the low. So if I use this, I want to look at the very, very low, right? The very low, and we're still holding anchor VWAP for Tesla, right? From the lows, from the January or December lows, however you want to call it. Now, if you want to say, oh, I only do anchored VWAP on the highest volume prints, well, then we can move the anchor VWAP, right? We can move that over to earnings. This was Q4 earnings. It happened in January. Q4 earnings, if we go there, we're still holding VWAP, the anchored VWAP. That's where the most volume came in for Tesla. When it first made that move higher, or it finished the move higher, okay? So we're still holding the anchor VWAP. That's pretty positive there, all right? So you get a lot of strength on Tesla. And I'm pointing this out because you only get these moves on Tesla every once in a while, right? And when it rips, it rips. Just like last time, nobody believed it would come back down. It went much higher than I thought it would. So if you get this RSI start to boost back to the highs, then this is going to be a nice trade or a nice entry point. But you do need the overall market to hold up, and you probably need a positive Tesla catalyst. On the intraday, if we look at the intraday, Tesla, and I'm going to switch charts here. If we look at the intraday, Tesla is trying to find a zone to find some support here, and we're not there yet. We haven't found that zone of support. And actually, the Qs are selling off. So the Qs gapped up. Now they're making lows. Here, the Qs up here. Tesla's going to move a lot with the Qs. So I think this is not it yet. Maybe we come back down to 230, right? Low of day for Tesla was 229. We had that bounce. This could be an entry point, but we're headed into the close below VWAP. So typically, if you're holding below VWAP into the close, that's a bearish sign, right? That is a bearish sign. We'll probably retest the 229 level. We'll probably, and if we can't hold it, we're coming back to 225. So two immediate supports for Tesla after bouncing from this macro trend, right, from the oversold RSI on the daily chart are going to be 225 and 230. These are your zones of support, and you're looking for the downtrend. You're looking for the downtrend to end. Also, you have the Dow doesn't really matter. You're looking at S&P and you're looking at the Qs to see if you get any support there. So if we jump over to the Qs, well, where are the support for the Qs? Are the Qs just going back to the lows? I don't think so. Let's look at a little more closer here. And if we look closer, that previous support for the Qs, actually, let's remove the pre-market activity. We don't want to see that. We don't want to see pre-market activity. Here we go. So if we look at that protection, or not protection, if we look at the Q support, we can see clearly that support is going to be, we're actually at support. Okay. Yeah. So last Thursday, we hit resistance at around 363. Okay. We touched that resistance. We also resisted 363, pretty much 363 Monday morning. So we're holding that level. Okay. We're holding, let's call it 362.50. We got to hold above 362.50 for the Qs. And, I guess we'll see how NVIDIA earnings come out. But that's a big level. If we can hold this level, I'm pretty bullish, right, in the short term. Pretty bullish in the short term. If we get below it, I'm going to be bearish, right, going into the Fed meeting. S&P, let's see what the S&P looks like as a proxy to this. S&P is also testing. S&P is a little weaker. And the reason why, I don't want to say the reason why, but this kind of goes with the narrative that, hey, I think tech is going to make a comeback here if we get those long-term rates lower. Long-term rates are still pretty elevated. They're still going up. And Jackson Hole, I think really next week's going to be the digestion of the Jackson Hole for Jerome Powell. If nothing changes, rates should come back down, right? Because you're getting more bond ETFs. You're getting inflows for bonds. That's going to support rates lower, right? As long as we get those inflows for bonds. Unless you get big sellers of bonds, U.S. Treasuries, you keep getting more sellers coming online, which could be China. Who knows? But we know what the real story. The real story is the U.S. Treasury is unloading supply. So they're creating more U.S. Treasuries on the market, and that's very bearish for the price. You need a buyer to come in and buy all those, which I think is going to be the reverse repo facility. So keep track of this chart right here. This is a very important chart. Oh wait, you know what? I don't even have it up here. I have it here. Sorry. Let's go right here. So this is global liquidity. This is something very important. What is this? Okay, cool. So this is global liquidity, right? And what we're looking at here at the top, I don't think you guys can see it, but anyways, S&P, you see the S&P up there. Now, that first shaded area where the arrow goes up, that's when we had an inflow of liquidity. Fed balance sheet went up, okay, this was the banking crisis. And what are we nearing right now? We're headed into another possible banking crisis, right? If this collateral keeps falling, regional banks in trouble, KRE, XLF, financials might be at risk, and that's going to signal for the Fed that they need to do something, right? And if they print more money, the market's going to go higher because that is more liquidity, and it's basically confidence and assurance that, hey, if something does break, which everybody's looking for, the Fed steps in, right? So that's what we got back then. Global liquidity also went up because the Fed pumped money. Fed net liquidity went up because the Fed pumped money, right? RRP liquidity went up kind of, but not really. RRP is the liquidity that I think, here's the funny thing, right? Here's something that people I don't think understand. Maybe I'm wrong about this. Yeah, KRE sold off. Exactly. The more KRE sells off, the closer we get to a banking credit event where the Fed steps in, period. Okay. Now, here's the crazy thing. First of all, this chart is just showing us that global liquidity needs to step up for the market to really gain some ground here. For the market to bottom out, you need global liquidity to turn up. That can either look from here, and global liquidity also falls as collateral falls. So think of it this way. This is very complicated, but you have, these are central bank balance sheets. This is money supply coming from the Fed, right? Or coming from the ECB or the Bank of China. But it doesn't show the cutting of rates. When you cut rates, you also increase liquidity. When your government prints fiscal policy or fiscal infrastructure bills or any kind of fiscal stimulus, that's also liquidity. And when you have treasury collateral go back up, which means somebody's buying the bonds, that's also liquidity. Okay, so there's a lot of liquidity factors. Right now we're getting, I guess you could say, money supply liquidity going lower, but we need interest rate liquidity to come up when they cut interest rates. And who just cut rates? China. China will keep cutting rates. They cut rates twice in 3 months. Okay, now that's not the U.S. Maybe we're close, maybe not. But China cut rates. They have virtually zero inflation. Japan maybe cuts rates, or they just keep pumping liquidity. Brazil may cut rates, or they keep pumping liquidity. Who knows? But I think China's going to have to lead the charge, especially you see the headlines. China is weak. China keeps weakening. Those are the headlines currently. And I think they're going to have to increase that liquidity at some point. So back to the, back to the market here, right? Looking at who is this? SPY. So yeah, that global liquidity is pretty weak. And then KRE, yeah, we'll take a look at KRE here. This is another signal of weakness for the market. If KRE rolls over, and yeah, that's a double top right there. That's a double top. We're breaking the trend to the downside. I'm expecting, this is why I think too that Powell actually comes off a little dovish, and I think he's gonna signal a pause. I think he's gonna signal a pause, right? And then he might be a little more hawkish. It's a little early, but he's gonna signal a pause. And I know people think, oh, if he signals a pause, inflation goes up, bro. No, it doesn't. Inflation, the rate of change of prices aren't going up because he calls on a pause. That's not the case. Asset prices will go higher, not food prices. That makes 0 sense. Okay? The only way food prices go up is if there's more demand coming into the economy and global supply chains break, meaning we'll go to this. We'll go to commodities because you could get that from commodities, but we're not seeing commodity inflation. And then we'll come back to KRE because KRE, if it rolls over, then the Fed's going to have to do something about that. So food prices, right? We'll look at some of the major commodities, and they are easing. So I think next month we're actually going to bottom at some point in the S&P if this continues, because the most important factor right now is going to be inflation. So okay, oil, where's oil headed? Well, technically oil's headed lower. All right, it's headed lower. This is the month of August. We're almost done, and that's going to mean lower CPI. Very positive about that. What about nat gas? Nat gas, look, nat gas is going nowhere. So if you have the same inflation, the same natural gas energy prices month over month, your inflation is 0. It doesn't go up. That is 0 inflation. All right. Copper's trying to make a bid higher, right? But it's still pretty low. It's not surging, and lower inflation. How about wheat futures? Wheat futures are selling off, despite what you hear. Oh, another crisis. Wheat is a huge component to food. It is at a low. It is at a major technical support. But if wheat keeps going lower, it just stays where it's at, lower food prices, right? Globally, you're not getting commodity inflation. It's not happening. The only inflation you may get right now is either oil prices go up or we see wage prices go up, but we're not getting wages. We're not seeing it in any of the PMIs or the forward-looking data. There is no sign of that. So it's really banking, Chris. I think we're actually at a risk of deflation if those banks do collapse, if the collateral does collapse. So it's a tricky time. It is a tricky time. I know it's confusing, but these are the risks that we're looking at. This is how we navigate the market. And hey, I think Tesla is poised to go higher. So switching over to crypto, right? Actually, I might have these crypto charts. See if I got them all on here. Total crypto market. Where's the total crypto market? So this is the total crypto market, right? It looks like trash. Broke the uptrend. Did break the uptrend. Let's do some technical analysis. It looks pretty weak. But you get the RSI extremely oversold. What happens when you get oversold? You get a bounce, right? You get a bounce here. You get a bounce here. Now, the bounce doesn't always sustain itself, but you are getting a bounce. And so I think, we consolidate from here. Maybe we form another triangle or a flat wedge pattern. So we could see this happen. We could be seeing crypto just form a wedge here. I think this is very possible. Okay. Now we know the uptrend is done for the crypto market, the overall crypto market. That is pretty much nothing to look forward to. Now we have a giant wedge. Okay. Now we have a giant wedge here. So you go from uptrend to wedge to downtrend. But right now we're in the wedge. If we break down, then we're in a downtrend. That's going to prolong the breakout. That's definitely going to prolong the breakout there. That's the total crypto market. What about the altcoin market? This is altcoins minus Ethereum, minus Bitcoin. Nothing's really changed here. Still moving sideways, right? Still moving sideways. You really need long-term rates to come down for crypto to find a bottom. Okay, you need long-term rates to definitely come down if you're going to get a bottom there. So yeah, that's the total crypto market. Now, when we look at Bitcoin dominance, okay, Bitcoin dominance has been going up, and it's finding a support here. You really want Bitcoin dominance to just trade sideways for the altcoin market. If it goes up, you're probably getting a sell-off in the overall crypto market. But in the short term, we are still bullish on Bitcoin dominance, and that brings us to ETH to BTC. So if Bitcoin dominance is up, you're going to get ETH versus Bitcoin stalled, and we are seeing that stall. I like to look at the monthly chart. It's a little clear here, Bitcoin versus Ethereum. But it's still in a very look at this. We're still looking very bullish for Bitcoin versus Ethereum. Okay. So we're just completing the wedge. Now we do need the ETF. There's a lot of ETFs that are being that are going through regulation right now. Not through regulation, but processing. There's a lot of ETFs, a lot of false signal announcements. But as soon as these ETFs come online, I mean, whoa, what's going on there? That's it. This thing is going to launch. Okay, we should be launching off. What does the RSI look like? Yeah, the RSI is almost back down to the lows. And then obviously, Chainlink still consolidating. Biggest, longest consolidation of any altcoin. I don't think you'll find an altcoin. I don't even like to call this an altcoin, but it is still an altcoin technically. I don't think you're going to find an altcoin that has this level of consolidation versus Chainlink, right? And remember, BlackRock's whole thesis is we want to tokenize everything. The way you tokenize it, you have to bring Web 3 to Web 2, right? You have to bring private blockchains and connect them to public blockchains. You need institutions to be able to access Web 3, to access smart contracts. And the most dominant application, the most dominant infrastructure to allow those interoperability mechanisms to actually work is going to be Chainlink. So big consolidation here. A lot of buyers, people selling at the top. If you want to be perfect, buy at $5, sell at $8. But by the time you do that, it probably launches off, and then you're gonna be pissed. But either way, Chainlink is still looking pretty solid. I know you have Cardano, you have a lot of other ones. Give us some crypto ETFs. Crypto ETFs, there isn't really any ETFs, but if you want a proxy, you can go MicroStrategy, MSTR. Right? MicroStrategy is pulling back. It has a big short interest, big short float. That big level is about 350. So beneath 350, I'm bearish. Above 350, very bullish for a Bitcoin ETF. This is if Bitcoin goes higher, right? And you're not getting that actual ETF. So yeah, MicroStrategy is one. I mean, some people say Coinbase, but Coinbase has some other regulatory risks to it. Coinbase, I don't think is more as an ETF as much as MicroStrategy is. Some people say Mara. I don't really like these because they don't hold they do more mining. They don't do a whole lot of, they don't hold as much Bitcoin as MicroStrategy. Basically, the whole company is technology and Bitcoin. That's it. So I like MicroStrategy as a proxy. It has a humongous short float, which means at some point, shorts are going to have to cover their positions. And that's kind of what we saw earlier. They're going to have to cover their positions of Bitcoin if the price of Bitcoin starts to go up again. Modern day, I guess so. No. Yeah. You do have Grayscale. You have who is it? For Grayscale, you have what is the Grayscale ETF called? I don't really like the Grayscale one, to be honest with you. I don't like that. because it goes to a discount. I don't like the grayscale one, but there is a grayscale. You also have Ethi, but again, I wouldn't mess with these. I think your best bet, honestly, other than ETFs, is literally just owning your own Bitcoin or just buying it off Coinbase. That's what I think. Modern day scammer, somebody says. Yeah, that's what it feels like. If you're not familiar with the crypto space, you don't really understand how it works. That's how it feels. Same thing with Apple back in the day. Tesla today. Tesla's still a scam to a lot of people. Apple was a scam to a lot of people. Google, Facebook, it always feels scammy if you don't understand the industry or where it's going. People do say MicroStrategy is a scammer also. He's a Bitcoin shill, whatever. I mean, it's Bitcoin, so it's a whole nother space. It's a lot different data than the stock market. Right? It's a new emerging market, so it's really confusing, really hard to understand. But yeah, the grayscale is GBTC, I believe. Yeah, there you go. Grayscale Bitcoin Trust is GBTC. But I don't. Oh, look at it. This thing actually looks more bullish than Bitcoin, but I am not a fan of it. I'm definitely not a fan of it. I rather just own the real Bitcoin, but it is trending higher. Yeah, it has a nice trend to it, huh? Yep. So there's your Bitcoin ETFs right there. See what else we have. Oh, okay. SMH. I think SMH is starting to pull up a little bit. Yeah, that's it. Really, it's all about the Fed meeting on Friday. Everybody's looking at Nvidia's earnings to see if there's going to be a technical sell-off from Nvidia. Because remember, Nvidia started the bull market off in the last, was this Q2 earnings. Nvidia started the bull market off. What is Nvidia looking like? So this could be a sell the news event going into tomorrow. Or wait, is earnings, when are the earnings? Why does it say, wait, let me double check this. Pretty sure it's tomorrow, right? Nvidia earnings? Yeah. Yeah, not till tomorrow. Oops, I got to plug my computer. I didn't even know it was about to die. So that's what we got coming off. So before my computer dies, yeah, let's finish out here. Housing market is at risk, right? The mortgage applications are down, starting to roll over because those long-term rates are up. And it's really going to come down to Jerome Powell making a shift or making a change here. I think of course, I'm a little more bullish. I'm a little more biased, but I don't think he's going to come off more hawkish when the bond market is tightening for it. So right now, 30-year yields going higher. The bond market is doing what it's supposed to do. It is tightening for the Fed. If the bond market tightens for the Fed, and essentially your Fed doesn't have to do that. The Fed can allow the bond market to do that for the Fed, right? But the tricky part is if the Fed does pause and say, okay, the bond market's doing our job, then the bond market typically starts to fall. The question is, or not fall, it starts to bid up. The question is, do we get yields come down on the long end or the short end? The bull scenario, the best scenario would be that short-term rates start to roll over, right? These 3-month treasury yields start to come down because there's a bid on treasuries. And the U.S. Treasury issuance slows down. Okay, we want the U.S. Treasury issuance to slow down, which is they're near the end of their issuance. They're issuing like $1 trillion worth of U.S. Treasuries, which puts pressure on interest rates to the upside and bonds to the downside, right? Once that's over, you get demand coming back in, or you get supply slowing down the decrease in that liquidity. So hopefully 2-year yields can peak out here. If they go higher, we're in trouble because the whole bond market is going to be falling apart, and you'll probably really get some banking risks come onto the market, some black swan opportunities. But then again, the Fed will likely pause if that is the case. Okay. I was for sure that the V-shaped recovery on Nvidia was not caused by price patterns. It was news. The V-shaped recovery on Nvidia. I hear that there's just a lot of people FOMOing into Nvidia still because they missed it before and they don't want to miss this earnings report, which is really sketchy because, man, you don't want to do that. I mean, I would let it run. But a lot of people, a lot of fund managers supposedly cannot miss Nvidia. Also, remember the CHIPS Act still hasn't fully played itself out. So there's going to be a government bid for chips that is going to flow into Nvidia no matter what. Jay Powell doesn't care about puts or calls. Stay hard. Jay Powell, yeah, Jay Powell cares about his Jay Powell cares about his credibility, and so I think he's going to come off very hawkish, but he's going to put in some dovish tone on that meeting. That's my thoughts on it. But this is what we're looking at here. This is the bond market, 2-year yields, 2-year bonds, right? The proxy for the economy. We need this to slow down. It was a price target, and if we know anything, when funds say buy now, they are selling. Exactly. Buy side, sell side. I think we're going to sell off on Nvidia into earnings, and I think we're going to either find a bid for Friday or Monday after Jay Powell's Jackson Hole speech. And I'm really looking at the bond market. Can it slow down, right? Can we get a bid in TLT? This is a positive. We need TLT to bid up. And here's the good part. You're getting bullish divergence on long-term bonds, okay? So if we do get a pop in these bonds, rates come down and the stock market's going to find its legs. The dollar is going to roll over while we already have oil prices rolling over, making CPI even better for next month. So I'm still optimistic, even though it feels really treacherous and we need to go back to the lows. I'm still pretty optimistic. And the reason I'm optimistic, we're still in the bull market trend. The bull market trend is still in place for the stock market until this trend rolls over, right? There's no reason for me to get bearish until this trend actually breaks. And we have a lot of consolidation. We have a lot of support here, right? Dating back to August, September of 2022, right? Even further. So this is a big level that we have to hold. And we're basically just consolidating into that level or into the trend. And I think it's up from here. Looking optimistic, right? And look at the RSI. We're almost oversold on the S&P. So what else do we got here? So would say no. So would you say no to trying to buy a house right now? If so, when would be a good time? Yeah, do not try to buy a house right now. Rates are way too high, right? Rents are coming down. Rates are way too high. Wait for when to buy a house? When the Fed starts to cut rates. When the Fed actually starts to cut rates. Housing prices are falling in some areas. Look, some areas they're still hot. Miami's still hot. I think New York might be still hot, but like San Francisco, nobody's going to live there. It's too expensive. It's coming down. Phoenix, housing prices are falling to some degree. Rent prices are definitely falling. I think it's going to be a renter's market. You get more supply. We're getting a big supply of of multifamily home units being built in the U.S. So I don't think it's going to be beneficial. Here's the game plan financially for a lot of people, right? I am not an expert. I'm not a financial advisor, but I'm just looking at the data here, okay? I've been pretty successful myself. So what I think is happening is there's going to be a shift to renting, okay? There's going to be a shift to renting. Well, you don't own it. Well, there may be. Here's the thing. Rates do two things. They make housing way more unaffordable, okay? And they make cash more attractive. So what you do is and this isn't going to be everyone's situation, you funnel your cash into money market funds, right? I think you should just take risk on the market, but to be risk-free, you let your cash work for you. You let your cash earn interest, right? Savings, you save your money, you're actually getting interest on it this time. And then you rent. Instead of taking out a bunch of debt and paying 10 years of interest on a house, you just rent. And then once the housing market finally comes down far enough, we could get a secular downtrend also in housing prices. If that is the case, when it does come down or when rates fall significantly, then you take all that cash you earn. Now you have you put down a down payment, right? That's what I think for the most part. You just rent. And I know they say that's like throwing away money, but sure, but you're not locking in slavery, right? You're not going to be locked in a slave rate or go live with somebody or, maximize your rents. Do what you can. I hope Tesla continues going up, caught the bottom, and we are still holding price while. Yep, carbides, I feel you. I got in on Thursday. I think we hit like 212, 214. I think I got in at 216. I got a couple calls Thursday. I got a couple calls going down. I think I got a call at 227 and then 214, and we're squeezing higher. We did some BTC technical analysis on that earlier. Cali is stupid expensive. No one buying or selling real estate. A lot of people coming into Phoenix, though. The only problem is Phoenix prices for the cost in Phoenix is pretty high. or in Arizona, I guess in Arizona, who I don't know where the best deal is to live. Everybody's situation is a little different, but for the most part, right now, cash is the new bond market because you're getting yield risk free, and renting is too expensive. Buying a house is way too expensive for most people, and you just got to diversify yourself. As in, okay, I'm going to save some cash. If you have a big boatload of cash, let it yield for you. Let it yield per month, depending on how much you have. Sometimes it doesn't matter. You're better off just buying crypto. No, I'm just kidding. But I am not kidding, because the bottom of Bitcoin is going to yield you way more than just holding cash, right? But again, it depends on your financial situation. If you have cash to throw away, take risk. Take risk. Stocks outperform bonds, outperform cash over time. Bitcoin greatly outperforms the stock market and crypto market over time at the lows. And we're near the low in crypto, right? And you can say, oh, I don't believe in it, it's going to crash. Well, they say that about the stock market every day. There's a reason why BlackRock is filing for an ETF. That's pretty much the signal that, Bitcoin is legit. Not all of crypto, but Bitcoin is legit. Not even the whole stock market is legit. Companies fail every day, every week, every month. Stocks come in and out of the S&P 500 all the time. So, it is what it is. Educate yourself first. But yeah, that's all I have for you. Tomorrow, let's look. What do we got looking forward? What do we have looking forward? Tomorrow, there's not really a whole lot of economic data other than the housing market. We get new home sales tomorrow, and those have been up pretty solid, right? New home sales have been up. So we just have new home sales. We have S&P manufacturing flashes, or basically the S&P. This basically a look into the forward, PMIs, or the forward-looking manufacturing sector. If this thing keeps rebounding, I mean, economic growth, at least the U.S. growth, is starting to pick up. Okay, so this is good for the economy. This is why I still think stocks are gonna find a bottom here and go higher, because EPS, or earning estimates, right? Earnings for stocks move off of monetary policy, fiscal policy, or earnings. And right now, the fiscal policy is very strong. Fiscal policy is pumping into the market. Monetary policy is tight. And then stock earnings are due to go up because, interest rates are kind of rising, but they're due to go up because, we're seeing consumers spend a lot more. So I think that's the case. We just need oil prices to stay lower. Building permits, we got durable good orders on Thursday. We'll see the growth outlook, initial jobless claims. That's another thing to keep track of. Where's the labor market? Is it going to stick where it's at? Is it going to go higher? Is it going to go lower? We don't know yet. So, that's kind of a look. And then Jackson Hole on Friday, Michigan inflation expectations, 5-year expectations, 2-year expectations, and Jackson Hole symposium. That's the biggest thing we got going forward. Other than that, that's all we got. Any breaking news here? Nope, not really. Fitch places American savings banks on rating watch lists negative. So all these rating agencies downgrading the debt for U.S. stocks in general, I think is just going to lead to the Fed pausing. My guess is the Fed does not pause. Obviously, on Friday they can't. They don't pause till September. But I think the Fed's going to say the same thing they always have. Inflation is too high. We have to continue our monetary policy. We do see progress in the housing market. We do see progress on inflation, but some inflation is too high. Blah, blah, blah. Nothing new. As long as there's no surprises from Fed policy from the symposium, as long as the tone leans a little more dovish versus the past, I think the market's going to digest it pretty well. That's all I got. You guys stay blessed. I'll catch you again tomorrow if anything new comes up. We'll look at the technicals. Right now, I think we're just trading off technicals, so we'll keep our eye on the technicals. Look out for Tesla. If Tesla holds here, Tesla looks very sharp for a sharp rally, or at least a bottoming of this trend. Tesla's pulling into the trend, and it looks pretty solid. U.S. tells China to be more transparent with economic data. Haha, that's funny. And China will keep printing. So that's what we're looking at here. Until next time, we'll catch you guys later. Peace. Stay blessed. Get your exercise. Get your workout in. Keep a growth mindset. Keep learning.